You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and Jill Malandrino.
All right, everybody. That intense music means it's time once again for a fun show. It's not super intense. We like to have some fun with it. It is, of course, Options Bootcamp, the program where we break down the sometimes scary, impenetrable, off-putting world of options and explain how you can use these products in your own portfolios. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. And wherever you're listening to this, could be iTunes, could be our site, could be one of our other many partner sites out there, or one of the other places, the legions of outlets that list our shows. Make sure, if you haven't done so already, that we enjoy you listening to Bootcamp. Make sure you, if you haven't already though, subscribe to the full network where you get all of our shows. You get daily news, you get all of our educational stuff, volatility, advisors, option, all the good stuff that we put out on the network. Quite a few shows, about a dozen of them now. So we guarantee you, at the very least, you will not be wanting for options content. And of course, wherever you listen, including those of you lucky enough to join us live here on the show, we have these nice little surprise live episodes we do throughout the week, as well as our usual live schedule. So if you haven't already, make sure you grab that Mixlr link. You can follow us in Mixlr if you want to know when we go live. The second we do, you get notified. Then you can jump in for programs just like this. Always a lot of fun surprises in store over there on the Mixlr throughout the week. And again, of course, however you listen live after the fact, make sure you do hit us up. Those questions, those comments, those insights, we do like to hear from you guys. And quite frankly, a lot of you do write in. So we'll make sure we get to a bunch of those on the show today. I also want to make sure I acknowledge and give a shout out there to all of them. I know a lot of vets like this show. I think maybe it's just the name, but also I know a lot of vets are interested in learning about options. I'm hearing more and more from different audiences and different players out there that they're seeing a lot more veterans getting engaged in the options space. It's something we like to see. We're glad to see that this program has resonated with that audience. Probably has something to do with the fact that this show's up there on the Armed Forces Radio Network as well. Probably has a little something to do with that as well. So welcome to all of you folks as well. Hope you're having fun on the old drill instructor proving ground. Speaking of that proving ground, joining me today, I got my usual cohorts, my companions, my partners in Options Bootcamp crime, starting off with the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the Bootcamp drill instructor proving ground, sir. It has been too long.
Well, hello, Mark Longo. How are you? I'm glad to be here. We got an exciting darn show planned, and I can't wait to get into it.
I'm excited, too. And also joining us via the magic of telephone, all the way from New York City, we've got Miss Jill Malandrino, the global markets reporter over there, beaming in from the markets mecca, that is NASDAQ. Jill, welcome back to the show, to you as well.
All right. Thanks for having me back. I love the music. It reminds me of WWF in the old days when you'd walk in and super exciting with the fireworks and the pyrotechnics.
There you go. That's what
Great
we were
way
going
to start
for.
the show.
We were going for the old Ultimate Warrior intro as you walked in there. So I'm like, there you go. See, the music resonates with everyone. Speaking of resonate, it's time to do just that. It's time to dive into our basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Prepare to learn. Yes, sir.
All right, I love that music. It always gets me moved. Like 4th of July, feels like we're in the middle of summer whenever we do this show. Okay, guys, welcome to the basic training. Like the name implies, this is the portion of the show where we break down some basic options concept or strategy or principle and tell you how you can utilize that in your own portfolios. And today, we're probably overdue to revisit this topic. In fact, I know we are because you guys hit us up on this topic almost more than almost any other. And it seems like these days we're getting it a lot. Just because of the market conditions that we're in. We are, of course, recording the show, listeners, right in December of 2017. So we're at the end of yet another protracted bull run. I say end, but it could continue going for quite some time. But at least for foreseeable future, or at least for recent past anyway, it has been quite the bull market. Certainly since election of last year, the markets have pretty much looked nowhere but up. So a lot of you are writing into us saying, hey, you know, what can I use options for in this type of scenario? I'm sitting on some gains, as you might imagine, in your broad index portfolio or in your equity portfolio. Yeah, maybe I want to use some options to hedge that. And so we're overdue to revisit this topic. We haven't touched on it actually quite some time. It's been since July of 2014, so over 3 years. I don't know how we've escaped it for that long because so many people are asking about it. So it's time to go back to that. I know we have a lot of new listeners in those last 3+ years. And also I know a lot of the platforms out there like iTunes and others to make it hard to go back sometimes to some of the older shows and they might truncate the feed. So we're going to do it for you. Make your life a lot easier. So let's start off with the basics, what you can do indeed when you're hedging out there. And as you might imagine, this is pretty straightforward question. Maybe before I even get into some basic examples, let's start with you, Dan, because I'd imagine this is something you get, I don't know, a large percentage of your clients probably come to you with a request similar to this. So what do you tell someone when they come into you saying, hey, I'm sitting on 10, 20, maybe 30% gains in the market. What do I do with their options?
I'll tell you what, man, that is the raison d'etre of options is to protect, I mean, that's why there's economic justification for options because you're able to protect your gains and still give yourself upside potential. So yeah, then when somebody comes to me with that sort of question, that begets a longer conversation and we do what we can to help them out over here.
Just as a helpful guy over there at Market Taker Mentor. Black hat aside, he can be a helpful guy. On occasion, listeners, you got to catch him on the right day over there. But of course, let's walk through some of your basic methodology. The easiest, one of the ones you may have heard a little bit about, you may be tangentially familiar with, is of course your basic put. That's kind of, as Dan alluded to, that's kind of what puts were invented for, which is effectively you're sitting on a stock or something else and you want to stay long it. You don't want to sell it out like you probably right now. You want to continue to participate in any upside that may exist out there, but you're a little worried. So let's give an example of one of our old friends. We've all made and lost many fortunes in our old friend XYZ. Let's say you came in, you bought XYZ at $100. It's now trading at 110, a few months, a year or so later, whatever fake time frame you want to use for this example. So you're sitting on a nice 10% gain. Well, what do? Maybe you call up Dan, or you come listen to a show like this. So you're still bullish on XYZ. That's an important component of this. But you're also maybe concerned that a little bit of a correction in the near term could wipe out some or all of those gains. So what can you do? Well, there's a bunch of different ways you can go. One of the easiest, simplest is to buy a nice, simple out-of-the-money puts. How far out of the money, how far you go, that's a topic for discussion, and we'll discuss it here today. For our example, we decided 2 months is a good time frame for some basic protection. So let's say you want to be very aggressive. You want to protect most of those gains. So you buy effectively the at-the-money strike, 110. You want to protect pretty much all of that. And in our example, that cost you $1. So now you've spent 1% of your gains because you stopped. But now effectively what you've done is you've stopped yourself out at 109. So no matter what happens in the market for the next 2 months, you know reliably, you have it written in a contract that you can sell that stock at 109. And when we get to some other examples later, you'll see why that is an important benefit. Jill, I know you guys over there at NASDAQ are talking a lot about trying to get the gospel out there about using options in these types of basic use cases like hedging. Hence your participation on a show like this. What are your thoughts on some of these basic use cases like coming in and people sitting on a gain in XYZ or whatever underlying, and they want to buy a put? What are some thoughts you have on that? It's a very basic but common scenario.
Sell them out and buy Bitcoin. I'm just kidding.
I think you're on the wrong show, Jill. We need to move you over to the Bitcoin
actually,
show.
this is a question we get a lot of over Twitter. We get this all the time, particularly as the tech stocks really have been what has been moving this market over the past 12 to 18 months for sure. We see that leadership with Facebook, Amazon, Apple, Netflix, Alphabet, Google, and what we like to do is we like to take a look at what the NASDAQ 100 index, it's called the NDX, and that tracks the top 100 NASDAQ-listed companies in the NASDAQ Composite X Financial. So that's where you're getting exposure to or a hedge for those stocks if you want to either participate to the upside or hedge those gains. And we're starting to see that strategies around NDX are certainly increasing. We hit a record open interest in October alone, in November, going into the November 17th options expiration, just over 200,000 contracts. So we're starting to see that in play more for those reasons where, again, if you want to participate in the upside, if you want some protection to the downside, within that narrow group, that's where you're going to get it.
And I got to imagine, I haven't looked at the OI numbers recently in NDX, but I have to imagine it's a similar use case to a lot of large other indices where I'd imagine this time of year or this after this market conditions, you're probably seeing a lot of people doing exactly what we're talking about right now in NASDAQ, which is coming in and buying a near-term, near-out-of-the-money put to hedge and protect against some of the gains that they're seeing out there. Is that pretty much what you're seeing out there in NDX these days, Jill?
Yeah, and that's a lot what we're seeing, and it's so timely with the week that we're talking in right now, from last Friday's action up until today, that we are seeing that sector rotation where we have seen money come out of those tech-heavy names and go into sectors that have exposure to the expected tax code reform. So you're seeing it move into financials, into materials, into industrials, and that's just part of natural sector rotation, and that's what we've seen, and that's why when you are using protective strategies after the significant runs that these stocks have had, that's when you really see it come into play, because there certainly was that bifurcation in the market between Dow and S&P stocks versus what was happening in the comp because of that sector rotation.
Yeah, we're not even going to touch on the tax issues today. That's something we probably could do a whole many episodes on the tax consequences of utilizing options, pros and cons. Maybe that's not a bad idea actually for an episode coming up. So maybe we'll put that in our stocking for another day. But we broke down the basic. That's pretty much literally almost the most basic hedging type trade you can do. Coming in, buying effectively an at the money put about a month or two out. And you pay that premium. You paid your $1, so you paid 1% of that 10% gain you made. So you're up down to 9% now. That's a drawback, obviously. But the benefits of that, and there are many. I'm not sure. Probably people are probably. I think we might actually have a listener question to this effect later. So maybe I'll just cheat and answer it now. But I think people are probably asking yourselves, well, why would I do that? Why would I buy this put and spend 1% of my precious gains versus just, hey, I'm going to work a limit stop order at 109. And so I'll get stopped out if the stock drops down there. Mr. P, you probably get this question a lot. Why would someone do something as crazy as buy a put versus working the limit order and keeping that good cash for themselves?
Well, yeah, I mean, Jill alluded to, the idea that you still get you still get upside participation if you buy a put, and it's interesting. I was kind of looking a little bit through the agenda here. I don't want to get too far ahead of ourselves, but all the different strategies and all the different, tactics and strategies that you can do each have their own unique sort of time and place, which I think we've talked a lot about here on Bootcamp. Buying a put is the most rudimentary strategy used to protect gains. And it has a lot of great advantages, namely being able to protect upside, but it has some disadvantages too. And I don't know if we want to get into that yet, Mark, or if you want to hold off.
We'll get into that in a little bit. Maybe we'll get into that when we answer some of the listener mail a little bit. But one of the primary advantages, obviously you're going to pay for this. So what are you getting for that? You're getting to be able to continue in the underlying. And like I mentioned earlier, you're getting that kind of contractual guarantee. The entire options business is standing behind that contract you just bought. So that means effectively, no matter what happens, this underlying could go all the way to zero. Guess what you can do? You can still sell it at 109 using that contract. It's a nice thing. In fact, I have a listener question about that too. What happens if the underlying goes to? I'm answering all of them at a time. I should stop myself before I use up too many, answer too many of the listener questions. But effectively, you have this guarantee. And so that's important. We've seen that many times just in recent years in the marketplace where we have these mini crashes, these flash crashes, call them what you will, and markets open up aggressively lower. And guess what happens in those environments to your stop? Oh, I'm stopped at 109, but guess what? The stock didn't print there because it opened up at 103 or 101 or 99. Guess where your stop's getting filled? It's not getting filled at 109. It's getting filled where it opens up. So that's the risk. And we've seen this many times. It's risk out there to work these orders. So if you're going to do that, if you're worried about that, and you want to, a lot of people like to sleep at night when they're trading and watching their money. They have day jobs. I know it's a crazy thing, but they like to actually sleep at night. So buying a put insulates you from that type of risk, and it allows you to sleep at night, which is always a nice thing, and of course protects you from some of those crazier market environments where people are things get a little crazy. Now, Jill, you mentioned the NDX before. That brings us. I was kind of mostly referring to kind of basic single equities here, but that brings us to a topic that's probably a little bit more complicated for some of our listeners, but also one that's relevant to a lot of them. A lot of them may have portfolios that effectively line up to the S&P or the NDX or the Russell or some other index out there. So that's when things get a little bit more challenging. What would you say to someone who's coming up and saying, hey, I want to hedge my portfolio using puts, but what do I buy? I'm mostly allocated something that's close to SPY or I'm close to NDX. What would you advocate for that person out there, Jill?
Well, you could do it if you're a retail investor. You certainly could do the NDX, but if you're more comfortable using ETFs as your underlying, you can go with the QQQ. If you have a portfolio that's weighed more to the Dow or the S&P, there's certainly ETFs that you can use there as well if you're more comfortable trading the underlying ETFs, because it is a little bit different trading index options versus ETF options in terms of settlement and cost and so forth. So you can certainly apply the same strategies. A strategy, whether you're a retail investor or institutional investor, the strategy themselves don't change. Buying puts for protection, put spread, and a number of other protective strategies that are out there, the strategy doesn't change. It's just the underlying and settlement that you need to look at. But they're all effective in terms of portfolio protection for sure.
Yeah, that's a good point. The strategies are the strategies. They don't change no matter what you're trading. Buying a put on gold, buying a put on NDX, buying a put on XYZ, it's pretty much the same beast. So that's the nice thing about it. Once you learn how these strategies work, the underlyings may have different nuances to them, but the under strategies themselves will be the same. So the work you have to do here, and some brokers will have tools that will help you do this. You may have a random hodgepodge of stocks. So they might calculate that, and there's some other tools out there you can find that will help you do this. And they'll determine, hey, your beta is maybe closest to your 0.8 or whatever to the NDX or S&P or whatever the case may be. And so that'll allow you a little bit more knowledge of, hey, if I hedge using these options on this ratio, then that might help me a little bit in determining how exactly I should hedge. A little bit more challenging, again, when you have the broad kind of make your own version, your buffet version of a portfolio versus just a regular broad index. Like a lot of people out there like to use the broad passive indices. If you have those, it's pretty straightforward. All the strategies we're talking about here apply equally to those as well. And we kind of put a little rule of thumb. It's worth considering. This might change for different people, so maybe I'll let everybody else chime in on their thoughts as well. People always ask us, what should I spend on these things? What should I think to spend? What's a reasonable outlay? And again, reasonable varies by person and by everybody else out there. But a decent ballpark kind of rule of thumb figure to keep in mind, just straight up paying without any of the things we're going to talk about in a few minutes about how to pay for that outlay, how to pay for that protection, but just how much you should expect outlay-wise from buying these puts. For a decent protection, maybe somewhere in like the 3 or so month range, decent near out of the money puts, I think somewhere in the 2 to 3% range is not a bad ballpark. Mr. Passarelli, would you agree with that? Again, this is not factoring in things you could do to offset that cost, just kind of a net basic outlay they could expect. Are you somewhere in that range as well, or do you differ?
Yeah, I think if we're talking about a broad-based index or, one of the broad ETFs, and in these current market conditions with volatility where it is, Yeah, I mean that's pretty much right on par. Notwithstanding the fact that it sort of depends on the strike price, or what I like to call the deductible of your insurance policy, if you will. But yeah, I mean, I think right now 2% is probably about right for the market in general.
Now, you might hear that and freak out and say, oh, my God, 2% for a few months. Now, if I annualize that, you're talking 8% a year. Oh, my God, this is madness. Why would you suggest such? You're giving up all my gains now with hedging. Calm down. Dial it back. We're here. We're here to help. And now that's usually the first reaction a lot of people have when they see how much these things cost. Again, remember, we're talking about primarily indices and single name equities where the puts are expensive. People want these things. They're going to bid these up from a volatility perspective because they all want to hedge. So the puts are typically more expensive. The calls less expensive from a volatility perspective, hence that volatility skew we mentioned on the show before. That's working against you in these scenarios. So you have to find ways to play with that and deal with that. And so we're going to walk through a few. Now, the most basic example of how to reduce your outlay, like we mentioned that example before, XYZ was trading at 100. You buy the 110 put for 2 months for $1. So you're down to 109. So you spent 1% of your gains on that hedge, but you stopped out for 2 months. You might say, I'd like to reduce that a little bit. What can I do? The most basic thing you could do, let's say you do your analysis, your research in XYZ. You said, I'm not concerned about all my gains getting wiped out, maybe about half of them. So you can construct your hedge that way. So instead of buying just the 1 month put, you can buy that put spread. So maybe you buy 110 put for $1, you sell the 105 put. Again, same time frame, 2 months out. We'll keep things simple. For, let's say in our example, 50 cents. So now you've effectively cut your outlay in half. You're down to 0.5% instead of 1%, and you still have that hedge you need in that area you're concerned about. Now, you're going to get stopped out below 105 if something crazy comes to pass. But on the flip side, you've reduced your outlay by doing that. So the put spread, the most basic way you can go about and really kind of just take some of the sting out of paying for that. As long as you identify a nice, reasonable range where you're comfortable having your hedge on. And if you're looking for catastrophe insurance, that's a different ball game. You're going to want to buy puts and kind of stick with them. But if you're not worried about that, then this is a very simple, easy way to go. Jill, are you on board with that as well? Are you on board with the kind of the basic put spread being kind of the go-to starter way for people to really start reducing their outlay when it comes to buying puts? And also, I'm curious your thoughts on that rule of thumb I tossed out earlier, that somewhere in that 2 to 2.5, maybe 3% on the outside range for a few months of decent protection. Are you on board with that, or do you have something different in mind?
No, I would agree with you and Dan, and I would also want to remind everyone, you have to think of it like auto or car insurance, right? It's one of those things that you do have to pay for, and you don't want to be in a situation where, God forbid, you're in a car accident or you get severely injured, that you have to lay out an extreme amount of money. But you also don't want to be in a position in the market where you've had these extensive gains, particularly in 2017, 25 to 30% gains. Should we get a severe market correction, it would be just like not having auto insurance or medical insurance. So you pay to have that protection, so you don't want to think of it in a negative light. In fact, in basic options education, when you buy a put, it technically means you're bearish on the underlying. It doesn't necessarily mean that you're bearish on the market. It's just a smart way to have protection on. And I think sometimes there can be confusion when we look at option flow that's out there and so forth. The data doesn't necessarily tell the entire story. When you see a lot of put volume on the S&P or on the NDX, it doesn't necessarily mean that there's bearish sentiment out there. It's just what professional portfolio managers do to protect their gains. And I think another way to do it, whether you're using it as a hedge or strictly a directional position, certainly is the put spread that you had mentioned before. It helps to fund the cost of the higher strike put, and also gives you a little bit more leverage in terms of managing the position as well, where you could play both sides of it depending on what the market's doing if you're more sophisticated of an investor. But I certainly think that is the best way to manage risk, and I also think it's a smart way to protect gains that you've had, or if you want to do a standalone directional bet.
All right, we're going to turn it up now. Not quite to 11 maybe, but maybe like to 10.5. We got the basic examples out of the way. We're going to add a little bit of extra tojuice to the fire here, a little more sizzle to the steak. You may say to yourself, that put spread's good, but what else can I do? Because I'm still sitting on a 50-cent outlay out there. I want my protection, but like everybody, no one wants to pay for it. So what else can I do? And I have a reasonable upside expectation in my XYZ. I think I'm sitting at 110 right now. I'm protected to the downside around 105. I think it probably reasonably in the next month or so could rally maybe another 5% up to like 115 or so. So if you have that outlook, then what you can do is segue, take that put spread and add another layer to it, and it becomes what's called a collar. You're probably familiar with the notion of a covered call. That's pretty much you own the underlying, you sell. Typically an out-of-the-money call. It could be an at-the-money, could be in the money, depending on your flavor du jour out there. But effectively, you're selling usually an out-of-the-money call. In this example, we're definitely going out of the money. So you're going to sell out-of-the-money call against that. Now, if you combine that with a put, basic put, you now have what's called a collar. So you bought that put, and you said, in this case, let's dial it back. We didn't even do the put spread. We just did the put. So you spent $1 for it. Now you say, I think it can rally to 115. I'm going to sell. You have a 2-month put. I'm going to sell a 1-month call. Why did we do 1 month? Why did we do a shorter time frame? You can say, the 2-month call is going to get me more money. Well, remember, if you listen to any earlier episodes of this show, we talk about always maximizing that theta exposure that you have. So in the case of short and selling options, you want to maximize your exposure to the short end of the curve. You could even go weekly here, and that's a lot of people will do that if they're more active and a little bit more involved in the marketplace. We're keeping things simple, just going monthly. So let's say in our example, you can sell that 115 call that expires in 1 month for a quarter. Guess what? You just took off 25 cents. So now you're down to 75-cent outlay for that put. But guess what? It's a 1-month call. So let's say everything holds steady and the stock's at 110 again at the end of that expiration. What can you do? You can sell that 115 call again for probably somewhere around a quarter. So guess what you did now? You knocked off 50 cents or half of the cost of that put. Now you flip it around again. You say, that collar is pretty snazzy. What if I combine that with that put spread you mentioned earlier? Well, then you have an even more magical position. Now we are kind of turning it up to 11 or close to it. This is, I guess, there's no real name for this. I guess you can call it, I like to call it a collar with a kicker. I'm sure Dan may have a different name for this. But effectively what you've done now is you have the underlying. It's at 110. You're going to buy your 110 put again for $1. So it cost you $1. You stopped out at 109. Now you're going to turn around and sell that front month 110 call. 115 call, again for 25 cents. You can do that twice, 50 cents. That's a nice little return. We're also going to jazz it up a little bit. We're also going to sell an out-of-the-money 105 put. In our other example, we sold 2 months for 50 cents. We can do that again. We can also make it 1 month again for, let's say in our example, 25 cents. So either way, that'll kind of add up to about the same. Now you have 50 cents and 50 cents. Guess what? You just paid for your put. You have a position where you can participate all the way up to 115, so you get another 5% of appreciation on the upside, and you're stopped out effectively at 109 all the way down to 105. So it's a nice little position where you're protected to the downside. You really have $1 of downside and potentially $5 of upside. So it's an attractive thing, and guess what? It didn't cost you anything. So that's the kind of thing people are interested in. I don't know, Dan, what are your thoughts on this? First the collar, and then the collar with the kicker. And then do you have an alternate? I know a lot of educators out there have their own names for stuff. What do you call the collar with a kicker, sir?
Before I give you my fancy name for that, I just kind of want to look at kind of big picture here. When we were talking about this idea of buying a 2 or 3 or 6 month put or whatever, I feel like that's really, really great stuff to talk about for new people who are trying to learn options. But really, when it comes down to it, the criticism of that strategy, the people who say, spending 2%, that's crazy. Why would I want to do that? If it's 2% every 3 months, that's 8% a year, or if it's every 2 months, it's whatever, more. You guys are totally 100% right. And what can happen is that you don't even have to wait, 2 or whatever months for that premium to evaporate. Because if the underlying zips up really high, the put could become worth zero because delta moves against it too. So I am a big fan of some slightly more sophisticated versions of just buying a put, like Mark's talking about here, the collar and the split time collar.
Split time? That's what you call that, really?
Split time collar? What, you don't like it?
I expected more from you, sir. I'm not feeling that. I don't know, Joe, what do you think of that? Split time collar, are you on board with that? Are you buying into that? I think Dan could do better. What do you think?
I'm sorry, I couldn't. You guys are talking over each other. I couldn't hear you. I'm sorry.
What do you think of Dan's name for that? Essentially, a collar with a kicker, the split time collar. Do you like that?
It's interesting, but I would say too. You have to remember when you sell the covered call, it does cap your upside as well, and it could potentially be called away. So you have to ask yourself. It's almost like on the flip side when you're selling a put, are you prepared to own the stock? Are you prepared to sell your stock should it get called away? So you really have to ask yourself how long-term, how married to that equity position are you? So that's one thing I would just add in there as well.
Yeah, you definitely have to do that math before you write that call. If you're not comfortable giving up your upside, and I've heard some people argue that in collars, no one wants to sell the call; they're just doing it to pay for the put. There certainly is some psychological truth to that. At the end of the day, everyone wants all their upside, and they don't want to surrender any of it. But at the end of the day, if you do that, you have to be willing to pay for that put. Things are not free. There is no free lunch even in the option space, even though we just explained to you how to get some nice free puts. So play with the strikes, play with the examples. I would also caution, a lot of people like to use zero cost collars, which are keeping the put and the call in the same expiration month. I'm not a huge fan of those because I mentioned before, maximizing theta is kind of the name of the game here. If you want to do that well, you have to put out a little bit, usually somewhere in the 3, sometimes 6 month time frame. I've seen some studies that show 6 months is optimal for that, and you want to push the call up to at least monthly, if not weekly, if you can handle that. And so there's a lot of trades in there. I know there's a lot of commissions and a lot of activity, but the flip side is the activity, your put's not going to erode as much, and also your call will get a nice repeating amount of juice for you every week or every month, whatever cycle you're doing it on. So Dan, horrible name aside, what? I wish I had time to put out a poll, see what listeners like, but I got a feeling they're going to go with ours. We're just going to call it collar with a kicker for the rest of this show. But horrible name aside, do you like that strategy? Do you use that a lot?
Yeah, I do. And I kind of want to go back to one of the things that you referenced. You said, you can do this and have the protection and not pay for it, because you generate enough on the shorter term calls to pay for the put. And yeah, that's totally great. Like financially, you don't pay for it, but like if you think about it, like conceptually, you kind of pay for it with labor and you pay for it with risk to the upside of missing out on opportunities. So like, yeah, you definitely don't pay for it, but it's important to point out, like Jill mentioned, the trade-offs, and you do kind of give something up, although if you're pretty nimble and you really watch, your trades and sort of react to things to do what you need to do, financially, it won't cost you anything.
What was that name again? I want to put it out there to the masses, see what they say. Split time collar, is that what you said?
Split time collar. Okay, now I need to rally my troops behind some
I'm going to put
here.
it out there. We're going to do a little flash poll during the show here. I'll copy you on it so you can let your heathen masses vote in and sway the results if they want. There you go. It's live now. So we're going to keep an eye on that. See how our listeners are pretty savvy. They know good stuff and they know garbage when they hear it. And I have a feeling that they're going to chime in on that one. While we're waiting for them to chime in, you guys have any takeaways? Maybe Jill, we'll start with you. Obviously, a nice basic overview. If you want more in-depth on any of these topics, we've covered puts and put spreads and covered calls and collars individually in separate episodes in the past. I encourage wherever you're listening to this show. Could be iTunes, could be our site, could be our app, could be the NASDAQ site, wherever you're getting it. Make sure you scroll down a little bit or just search for those key terms. You'll find the episodes that we did addressing each of those topics in length. So if you're saying I'm not familiar with some of these topics, that's a good way to do that. But this is a nice little overview, a nice little primer to set you on the right path. That said, Jill, any interesting takeaways you got on hedging, any of these topics we discussed so far?
Well, I would definitely invite people to take a look at what we have going on business.nasdaq.com. We are going to start introducing a ton of NDX content on there. On my show, Trade Talks, we've done quite a few episodes on that, and we're going to start to do more frequent content, at least once a month, so you can really see how the NDX volume is picking up in different strategies that we're working with. And also, shamelessly, for one more plug, if you want some pretty solid options content, next Friday, December 15th, for Quad Witch, I will be co-hosting with our friends over at TD Ameritrade Quad Witch expiration on the NASDAQ Felix trading floor. We still have open outcry there, so it's an entertaining day to say the least, and we'll have a number of RIA and ETF strategists on with me, but that's going to be a pretty fun live shot of options trading happening live, and we'll be talking a whole bunch of strategy and so forth. So I would definitely love for you to share that with the viewers because it's going to be a great day of content.
I see Dan trying to manipulate the Twitter masses. It's not working, sir. 100% of the vote so far in my column. Again, it's early. We got a little time left for the rest of the show. And Jill, look at you, the pro, getting all your plugs in ahead of time. We're not even done yet, so you got more time to work on all that stuff. But of course, that's a good idea too. I think you guys are doing the quad witching stuff. Maybe we should do another show. We're just coming up with all sorts of great topics for shows. Maybe we should do a whole episode around the kind of mysteries and nuances of expiration. What do you think, Jill? Is that a good topic as well?
Yeah. I mean, all these are fantastic topics. And yeah.
I like it. So yeah, we're giving ourselves more work here on the show is what we're doing. Dan, any takeaways here before we move on to some of the listener questions about hedging in general? Any of these strategies we outlined, or maybe something we didn't get a chance to talk about?
No, let's do it. Let's hear from some listeners.
All right, you heard the man. Let's do it. It's time for you guys to take over the show. It's time for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, Dan just pulled ahead here, but I'm guessing there's some shenanigans at foot here with this voting. So I'm gonna keep an eye. I think this is Chicago style voting. Vote early, vote often. I'm gonna keep an eye on this one as we dive on into your questions. Of course, the mail call. You guys know how to hit us up. A lot of you guys already do. You can hit us up a bunch of different ways via the live stream if you're listening live, via all the social media accounts that we're on, ad options over there on most of the major platforms, Options Insider on Facebook, via, of course, our mobile app, via the website, email, all no short of carrier pigeon. However you want to reach out to us, you can do so. Just like our first question here. Oh, this is kind of timely. Probably why they surfaced this to the top of the questions here. This came from Ariell. She's asking, why should I ever buy puts? I can use a stop order in the stock for free and then put that extra capital to work in my trading account. By my math, using stops instead of puts can boost your account 5 to 10% a year. That's a lot of cheese. That is a lot of cheese, Miss Ariell. We kind of just touched on this earlier in the episode, but it is a good point. You know, it's worth repeating, I think, probably here on the show. Puts do cost money, unless you do some of the strategies we just outlined to really reduce that outlay. But they do cost money. It's up to you whether you think that is worth it at the end of the day. I mean, if you buy your protection for your house or your car, you know, you're not going to be upset that goes to waste, probably. But in the case of options, you can take some reasonable steps to reduce that outlay. Your math, that's kind of, like I mentioned earlier, that's kind of, you just went naked, bought like, I don't know, say a 5% out of the money put every quarter in an index. It'll probably add up somewhere around 8 or 9% a year. So your math's somewhere in line for that. We don't advocate just doing that unless you're really concerned about the end of the world. There are a lot of ways you can mitigate that, and we just touched on a few of those. I don't know, Dan or Jill, any thoughts here for Ariell who wants to save their pennies and use limit orders instead of buying puts?
Yeah, no, I mean, Mark pointed out the most important thing earlier, just gaps. You know, I mean, stop orders don't prevent against gaps. You know, like, and really, the main reason for buying stops, in my opinion, isn't to protect against the smaller moves. It is to protect against the bigger moves. You know, like the smaller moves, especially if you're a longer term investment. I mean, or investor. You know, you can withstand a dip of 1% or 2 or 3 or something like that. You know, you're concerned about the big moves. And when those big moves happen, they often happen like overnight, like boom, there it is. Like there's the start of something terrible. And if you got to stop in, it doesn't help you at all.
Yeah, we have seen that of late. You know, those that can happen, and it can happen quite a bit. So it's something to be concerned about. We're tied now, Mr. P, by the way. Both names at exactly 50%. We got Trader Reed chiming in. He says his suggested name is schizophrenic. I don't know for that. I don't really know what he's implying there, but okay. To each their own. I don't think it's really schizophrenic. You got different views. I can see that maybe, but interesting stuff. Here's a fun one for you. Actually, there's 2 of them here for you, Jill. So put on your listening ears here. These are good ones right up your alley. First one comes through related questions. The first one comes from S Wars. He asks us, do we trade options through dark pools? And we had a similar question from Thankfulness. I like that handle. Thankfulness wants to know, do we have dark pool access? You know, this is This is kind of a common question we get. I'd say probably not as common as the other ones we was talking about, but I'd say like a couple of times a quarter people hit us up with this. Jill, why don't you explain to them maybe why dark pools aren't really a thing when it comes to options?
Well, not only that, but you wanted to trade on the exchange regardless, right? But no, we do not use dark pool access. That's for sure. We're going to advocate that. To be traded on exchange. I think the benefit to retail investors is to go through dark pools. How can I phrase this the right way? So I think you would get better, Dan, you could probably help me out here. I'm just trying to phrase this the right way, that you would get better pricing through a dark pool as a retail equity trader versus doing it on exchange. Like when you go through your Fidelities, your TD Ameritrade accounts and so forth, you're going to go through their dark pools and not necessarily trade on exchange because you will get better pricing. That's one of them. But Dan, maybe you can answer it better. I'm like at a loss for words with this one.
Yeah, I don't know. I'm a little skeptical of dark pools for retail traders and options anyway. So with the smart routing, it depends what you're doing. If you're putting on some sort of, credit spread that you're going to hold on for 3 weeks, I don't really think it matters much if you go through the exchange or through a dark pool. I'm all for trying to get better fills by a penny or so, but it's smart routing. The exchange is going to give you the best available fill at the time, and I'm skeptical that what goes on behind the curtain is any better than what goes on in the public eye.
I set you guys both up for this one, and you both let me hang in here. But no, this is actually the answer to this one is actually pretty straightforward. Which is the short answer to this is no. The long answer is a little bit more nuanced. But one of the nice things about trading options really is that there is that exchange execution requirement at the end of the day. At the end of the day, your order, unlike equities, which can be printed, and a lot of them are transacted in dark pools out there, you don't really see any options dark pools floating around. There's a couple maybe ATSs that attempt to replicate that, but the options dark pool as a thing doesn't really exist because all your orders at the end of the day have to be stamped at a place like a NASDAQ or a CBOE or a Philly or wherever you're going to go over there. They can get shopped around. They can get, effectively set up and all but executed on some of these third-party networks like, used to be AIM, now whatever, it could be Symphony, whatever the big messaging platform is. They'll do a lot of order shows there, but they can't execute it there. They have to actually stamp it and execute it on the exchange. That's a nice little protection you have in the options market that you don't really have anywhere else, at least in a lot of the other big market like equities where things can pretty much get executed anywhere. So you're looking for options execution, it's pretty much only on the exchanges. So that's an easy answer to Mr. Wars and Mr. or Mrs. Thankfulness, I don't know, is that there really aren't options dark pools. So there's not really a need for them in the traditional sense, and we don't see them. Here's a good one. This is not really a question. This is more of a comment. This is from, he actually mentioned you on this, Jill. This comes from our buddy Henry Schwartz over there at Trade Alert. This came in over the Thanksgiving holiday. We obviously haven't had a show in the last couple of weeks, so we're talking about it now. But he said who said option traders don't celebrate holidays? And he included a great graphic on this, which Henry is wont to do all the time. It was a nice turkey-shaped graphic. We'll include it in the show notes so you can see it, listeners. And it's got essentially all the big active names out there, and they're sorted by size in terms of volume. So you got SPY up there, of course, the Q's very active, Apple, VIX, you name it, all the ones out there, Amazon, all the names you know, and you can kind of look at it, and it's a nice little visual reminder of just exactly how certain names stack up against each other from an overall volume perspective. So there you go, Miss Jill, getting a little Thanksgiving love from our friend, the Flow Master, Henry Schwartz. What do you think of that?
He's actually going to be on with me next Wednesday, December 13th, talking about NDX. So we will certainly have Henry on with us for that. And that'll be a good one. He's a great interview, super, super sharp. And yes, the benefit of having Henry on is they have the coolest graphics over at Trade Alert. So looking forward to that one.
Oh, you have him in mind? I didn't know that. I take back everything I said. He's a horrible human being. No, we love Henry. He's a good guy. We love our Trade Alert over here. Let's go on here. we'll put that graphic in there. It's just a cool little visual reminder, listeners, of what trades out there on any given day. You can look and see how your favorite, and there's a lot of them on here. You could look, it's kind of fun. It's like a little Where's Waldo, finding your favorite name and seeing how it's things like Google, for example, and Google, not perhaps as active as you might think compared to some others out there. All right, let's go on to a lot of great handles this week. L Penguin. L Penguin wants to know, I have a question for Option Bootcamp. Well, you send it into the right show. You passed the first test. He goes on to write, I'm a new options trader, and I want to buy a leap call because it looks like the stock is going to go up in the next 12 months. But I don't want to commit yet. I also want to generate income, while I hold that position. What are your thoughts on selling the call while I have the leap? Also, this stock has an attractive dividend that I'd like to capture. Is this even possible? Interested in your thoughts. Thanks. He added on here, I think in a second message, I was thinking about buying deep in the money calls for the leaps, and then depending on where the stock is trading at the time, selling closer to the money. What you laid out here is one of my favorite strategies. We've advocated for it a lot here on this show. It sounds scary, but it's really very simple. LEAP, listeners, if you're not familiar, stands for Long-Term Equity Anticipation Security. So typically a year or longer is how far out these options go. But you can get these names out there for many years if you're looking at the right names. So that's usually when you have some sort of longer-term position or viewpoint on an underlying, you're going to do that. And he brings up a use case that's great for this. And it's just a simple stock replacement. Instead of buying the stock, which the best you can do buying the stock is 50% margin, you can come in and buy a call and put those Greeks to work for you instead of against you. So it's going to be much more capital efficient. And then he adds on my favorite kicker to that, which is, of course, selling a covered call against it. So this is a great strategy we talked about many times. I call it, this is another one that has many names. I like to call it a synthetic covered call. Some people, I know we have Mr. Overby and his people on our network who do that. They like to call it a fig leaf on his show. I forgot why exactly they call it that, but there's different names for this. I'm sure Dan has another horrible name in store for us as well. So, Mr. Passarelli, I'm a fan of this. I like it. What do you think, A, of the strategy overall? Are you a fan or not? And then B, he adds an interesting kind of caveat, an interesting corollary to this, which kind of adds a little wrinkle. He wants the dividend too. So he kind of wants to have his cake and eat it too. So walk him through why that may or perhaps may not be possible.
Yeah. As far as buying leaps, I think buying leaps and selling the call is really, really great under certain situations. The best situation it's really great for is when the underlying had a huge precipitous drop, like Lost Happens Valley or something, kind of bottomed out, implied volatility sky high in the short-term expirations, and you think it's going to slowly climb back. It's a sweet play right there. Some people would call this the poor man's covered call. Although, to be fair, if you think about it, it's not really like a covered call, is it? Because if you think about it, what it is you're short a call, short-term call, and then you're long a long-term call that's in the money. But synthetically, if you look at what a call is, like an out of the money or an in the money call like that, synthetically it's an out of the money put, right? So that's like owning the underlying and then buying the put. Buying leaps call is like owning the underlying and buying a put. So really, you know what it's like? It's like a split time collar, right?
I knew you were going to get back to that somehow. You can't let it go. By the way, you're losing in the polls, sir. Two-thirds of the voters choosing my way. They have taste. Our listeners have taste. But yeah, you're right. That's kind of why I hesitate. It sounds good, synthetic covered call, but you're right. It's not exactly appropriate. But it's. I think if people hear that, they intuitively know what you're talking about. And that's kind of what I like to go. So you don't mean really in the synthetic, like a form of synthetic put kind of thing, even though that is exactly what you're doing. You're right. But you're right. I like this strategy. It's great. The one you pointed out, maybe inadvertently, the one downside to this strategy, and the downside to a lot of option strategies is you don't get the dividend. If you only call in the money, out of the money, whatever, leap front month, you don't get the dividend. So if you're worried about the dividend, when that comes up, you'll have to do a little internal analysis and internal math. We've done some shows in the past on exactly how to determine when to early exercise or just sell out the call and buy the stock for that period. When that's worth doing, there's some quick footnote in that math you can do to figure that out. Just compare the put and the call. You'll figure it out. But in general, that's one downside to this. So if there's a really good dividend on this name, then you may want to reconsider, or at the very least structure it so that maybe the call goes, and it's a leap, it's going to be hard for it to go away, but maybe the call can go away right on the time of the dividend, and you could turn around and get some of the stock, or vice versa. But that's something to keep in mind. You do not get the dividend with this. You're kind of creating your own dividend stream, which is nice, but on the flip side, it's not a good way to capture a dividend. I don't know, Jill, do you guys get a lot of interest in the long-term stuff over there at NASDAQ, as well as, is this something you guys talk about a lot, which is in general kind of options as a stock replacement type tool?
You know what? We don't get a lot of leap questions. To be honest with you, the only thing that we'll get longer term is going back to the hedging conversation that we had earlier, but we really don't get much in terms of longer term options. I think what we see more is we from what I hear anyway, on the social channels, it sounds like our audience has longer term stock positions, and they'll, for the most part, write calls on them or buy protective puts, but they're not really using leaps as a stock replacement strategy, or they might be selling puts as a replacement strategy. But we don't really get it that much with leaps, to be honest.
All right, I understand. Speaking of which, Jill, you're very busy. I don't know how you keep all this up, because as you're doing this show, I happened to just check on our poll on Twitter, and I saw the NASDAQ account come by, and there you are talking to TD Ameritrade live right now. So I don't know how you're in two places at once, but I'm very impressed with your ability to multitask.
There are days I feel like that.
So you're in many places at once, quite literally right now, Jill, which is very impressive. Let's see, we're kind of running up against it. We got a lot of questions. Here's a fun one, actually. We don't get that. I've got this one in a while. Tom Matt says, whatever happened to the minis? Are they ever coming back? A good question. An interesting one. Jill, you're our exchange go-to person. I know the minis were kind of a surprise development for a lot of people. They had it seemed like a lot of industry support, and they kind of just fell by the wayside once they were launched, I think for a variety of reasons. I don't think I've ever had a chance to talk with you about the minis before. What are your thoughts, A, on the minis? They seem to have a lot of promise, and they kind of went away. And then B, what do you think happened to them? And then C, if you have any insight you want to share with our buddy here, Tom, about are they on the comeback trail, maybe break some news here for us, have at it. The floor is yours.
You know, it's funny because I haven't spoken about the minis in a long time either, and I'll just run through them quickly for people who are new to that. It's pretty funny. I have to actually do something on that because we haven't spent time on that here at all. But essentially, what they are, they're option contracts where the underlying security is 10 shares of the stock or the ETF or the index, and that's really the difference between standard options, which have 100 shares of the underlying security. So a lot of these are done with the indexes to reduce the cost, and even some of your higher priced or more frequently traded names. So, for example, like Amazon had them. But yeah, we haven't done much of them in a while, and I'm surprised to see that we haven't been doing more strategies on that. So that's something I'm certainly going to take a look at. That was a great question. But yeah, the big difference is it represents 10 shares versus 100 shares. And the main rationale for the introduction to them was to make it possible to place a directional bet or hedge on fewer shares of the stock or the ETF. But Dan, do you guys, I don't even recall really on your end doing much with minis. Even when we were at the street together, I don't really remember anyone doing much with that.
Yeah, they're funny. Like, there was some pretty great potential for them, but I don't know, they just never caught on. Like the one thing, the obvious thing is that the commissions end up being percentage-wise 10 times higher. So there's one problem.
Yeah, surprisingly, retail traders aren't stupid, and they realized a lot of things fell down with minis. Unfortunately, it's funny because we talk to a lot of exchange execs and brokerage firm execs and everyone in the industry at a regular basis, and I can't recall another time when a product had that much seeming push behind it from all different corners of the industry. Everyone was really excited. This is a few years ago, listeners, so you probably remember Apple was flirting with 700. All these other names were really richly priced. People were lamenting retail couldn't afford them anymore. Minis were the solution. They were the panacea to all the ills of the options world. Everyone wanted them. And then they launched, and as Dan pointed out, first off, brokers kind of used it as an opportunity to maybe try to gouge a little bit by charging full freight commission for a 1/10 size contract. The retail customers didn't really appreciate that. Market makers also never really embraced them, which was kind of interesting. It just shows what a damaged class they become in recent years. They can't take risk to really fully embrace a new product until they see it has some legs. And unfortunately, that's the chicken or egg with a new product. If they don't embrace it, the product probably won't get any volume. And so that hurt it. The spreads were very wide as a result. So that added to the costs of trading it. And then, of course, it seemed like the use case never materialized when people started looking at them and realizing, wow, it's really expensive from a commission perspective and also from an execution trading cost, getting in and getting out. These spreads are super huge. It's going to cost me even more to do it. I might as well just trade the regular product because it's cheaper and I get better execution as a result. So it's slowly but surely, they kind of withered and died on the vine. And now we're in this scenario where we get every once in a while someone writes about these things. I'd say maybe once every few months or so. So there still is some interest. They were a cool idea, and some of these names are getting kind of rich again, like Amazon and others. So ironically, actually, I think it was at this year's OIC conference where a couple of people out of the blue maybe made recommendations to me that sounded like they were hinting that maybe minis should make a comeback. That's all I heard about it. I haven't seen anything. Doesn't sound like NASDAQ's launching them again anytime soon. And I haven't heard any other. Most exchanges have effectively delisted these things. They said they weren't going to add new series, which effectively means once they expire, they went away. And so we haven't seen new series added. Maybe someone will buck that trend. I don't know. Maybe NASDAQ. Maybe next time Jill's on, she'll have some news to break for us. But doesn't sound, at least like anytime soon, we're going to be seeing that trend. Good question. We get a lot of. We have so many. We'll get to more on the next show. Don't worry, listeners. But unfortunately, that music means that's all the time we have here on the old Options Bootcamp. But before we go, funky tune. We like it. Let's go back around the horn and see what everybody's working on. Jill, you kind of gave us a nice little update. If people are interested in that TD, that thing you're doing with TD about expirations, where should they go? What should they do? And when can they check it out?
We will be broadcasting that live on December 15th, starting at 9:30, every hour on the hour, co-hosting Quadwitch, options expiration at the NASDAQ Felix Options Trading Floor. You could just stream it on Twitter. It'll be live on NASDAQ's handle, and I will be sharing it from my handle as well. But it's a good, for those of you who are new and don't have experience with the Quadwitch expiration, we're going to do a ton of stuff around that, and it's a fun day to participate. So we look forward to interacting with everyone on that.
Check out the Quadwitch. You can follow them. A lot of you probably already do over there at NASDAQ on Twitter. Probably the easiest way. Jill, if you like Jill's stuff, she's on that a lot. In fact, she's on it right now. She's talking to us. So follow them over there at NASDAQ. And that's the easy way to see their stuff. Of course, head on over to NASDAQ.com. They have a growing array of options content. We'll see if we can get this show up there if it's not already pretty sometime soon. So you can check this out while you're over there as well. Mr. Passarelli, before we wrap up, by the way, I have some bad news for you with the show pretty much winding down here. 63% saying they like Collar with a Kicker, sir. Only 37% giving any love to your horrible. I'm surprised you got that many, so you should be proud, sir.
Damn it, this is fixed.
You tried to rig it. I saw your attempts. They just failed miserably. Our audience has more sense than that, more taste clearly as well. That said, if they have taste, they want to come check you out, Mr. P, what should they do? Where should they go?
Yeah, we were talking about the minis, and it kind of made me think of something that actually has nothing to do with minis at all, but, it's close enough. I was going through some videos that we have for free on our website, and there was one on weeklies options. It's a real brief one, but it's great for the bootcamp audience. Visit markettaker.com/weeklies_options. Market, like stock market, taker, like taker, two T's in a row. markettaker.com/weeklies_options. And complimentary video teaches a little bit about weekly options. There's also one there on leaps, one on income trading, and a whole bunch more.
There you go. Check it out, markettaker.com. If you guys are listening to this, you say, I wish they would talk about this topic or that topic, you have suggestions, send them in. We love to hear from you guys as well. We're going to be covering a wide array of vast and interesting topics. You guys gave us some good fodder on this show for future topics as well, so we probably have a lot of homework ahead of us, but we're looking forward to that. We'll see you next time for more Options Bootcamp.
Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.